Looking at financial markets recently, it might seem relatively surprising that despite the very significant spike in inflation, for example, above 6% in the US, released this week, the interest rate market doesn't seem to care very much. And there's a number of reasons for that. The first one is central banks have taken the view that that spike in inflation is temporary. If that spike in inflation is temporary, in theory, this is not something they need to react to much. Another part of the explanation is that interest rate markets are taking a similar view to that of central bank, but also the fact that that spike in inflation and perhaps increase in interest rates are going to prove detrimental for growth in the medium to long term. Therefore, as much as short-dated interest rates are rising, the long-dated ones are basically fairly subdued and even in some cases dropping. The last reason why interest rates aren't reacting very much is that there is still a fair amount of support lent by central banks and other types of buyer to the bond market. There's a lot of purchases happening, supply is constrained, and that tends to suppress interest rates and keep them down. Now, the second part of my question is, should they care? And yes, they should care. And that current state of play with very low interest rate and very high inflation is not sustainable. Inflation will eventually come down. At the same time, interest rates are going to rise. So that should put US Treasury yields above 2%. That should put 10-year German bond above 0%. And we will get to more, let's say, intuitive relationship between inflation and bonds.